Hey everyone, welcome back to my channel. Today I have some breaking news to share with you. Silicon Valley Bank, the tech industry's favorite bank, has collapsed and entered FDIC receivership. This is a huge shock for the tech sector and the banking industry. Let me explain what happened and what it means for you. Silicon Valley Bank was founded in 1982 by Bill Biggerstaff and Robert Medeiros over a poker game. Its first office opened in 1983 on North 1st Street in San Jose. The bank's main strategy was collecting deposits from businesses financed through venture capital. It also offered banking services and advice to technology startups and venture capitalists. The bank grew rapidly over the years, expanding to 15 states in the US and opening offices in Israel, UK, China, Ireland, Germany, and India. It went public on NASDAQ in 1996 under the ticker SIVB. It also acquired healthcare investment bank Leerink Partners in 2019. They have been major lender to technology startups and venture capitalists. It had over $100 billion in assets and more than 3,000 employees. It was known for its innovation and customer service. However, things started to look down for SVB in the past few months. The bank faced increasing competition from other fintech companies and online platforms that offered cheaper and faster services to tech entrepreneurs. It also suffered from rising loan defaults and fraud cases as some of its clients went bankrupt or failed to repay their debts. The situation worsened this week when SVB announced that it needed to raise $5 billion in capital to meet its regulatory requirements and cover its losses. This triggered a panic among its customers who feared that the bank might fail or be taken over by another institution. They started to withdraw their deposits en masse, creating a run on the bank. On Friday morning, SVB collapsed after failing to raise enough capital or find a buyer. The California Department of Financial Protection and Innovation shut down the bank and appointed the Federal Deposit Insurance Corporation as receiver. The FDIC is an independent agency that insures deposits up to $250,000 per account holder at most banks in the U.S. It also takes over failed banks and sells their assets to pay off creditors. The collapse of SVB has sent shockwaves across the financial markets and the tech sector. SVB's share price plunged 87% over the past 2 days before it suspended trading. Other major bank stocks like JP Morgan and Bank of America also dropped sharply as investors feared that SVB's crisis might spread to other institutions or expose broader risks in the banking system. The tech industry is also facing uncertainty as many startups and venture capitalists rely on SVB for funding, banking services, and advice. Some of them might lose access to their accounts or face delays in receiving payments or loans from SVB or other banks that are wary of lending to tech companies after SVB's failure. Some of the well-known VCs that use SVB include Andreessen Horowitz, Sequoia Capital, Excel Partners, Kleiner Perkins Caulfield and Byers, Benchmark Capital, Founders Fund, Y Combinator, and 500 Startups. This is a developing story, and I will keep you updated on any new developments or information that comes out about